What's up, guys? I was assigned early on a covered call this week. The expiration was Friday. It's currently Thursday. I was assigned yesterday. If you've been watching my channel for a while, you have a pretty good idea of why I was assigned early, and that is a good thing. And I've always talked about, as the buyer of an option, you never want to exercise early because you'll be setting money on fire. But there were some rare cases in which you might, as the buyer, actually want to exercise early. So I kind of set up a covered call this week hoping that it would happen and I would get assigned early so that I could show you exactly what it is. Because I always give examples, but I never show a real life this just happened. I always make up hypothetical numbers. So in this video, you're going to learn why when you're the buyer, the only time you'll ever want to exercise an option early. And if you are writing covered calls, you are the seller of a covered call, the only time I can really ever think of a time that you're going to be assigned early and get exercised on. So I'm going to show you all the numbers. I got the digital whiteboard out. I made it a blackboard today, so it's not so bright on your faces when you're watching the video. And quick video, get you in and out, and maybe you'll learn something. Or if I've already taught you this, you'll get to see it in real time. So guys, this was a covered call with Intel, INTC. Okay, it was above my basis. It had an expiration of tomorrow, which is 11/5/2021. The strike price was $49.50. This was above my basis, so that was not an issue at all. And the premium that I collected was 34 cents per share. We know an options contract is 100 shares. So I got to put in my pocket, money in the bank, shorty, what you drink, $34, not that big of a deal. Now, Intel was just going up and up and up this week. So was that covered call pretty close to the money? When I wrote this strike, yeah, it was pretty close to the money. And I knew that there was something coming up this week, which was going to be the reason I might get assigned early. And that is the ex-dividend date. Now, the ex-dividend date is today, 11/4/2021. Now, what this means is that if you purchase shares before the ex-dividend date, you get the dividend of that particular stock. If you are to buy those shares on or after the ex-dividend date, then you do not get that dividend. So this was assigned early and I was exercised yesterday. So this buyer of the option, they exercised early to get the dividends of these 100 shares. Now, is that going to happen all the time? No. That's going to happen when we talk about intrinsic versus extrinsic value. And here's exactly what I mean. The value of the option is made up of this extrinsic or intrinsic and extrinsic value. So let's give the example of exactly what happened. This was assigned at close. At close yesterday, the share price was $50.39. Okay. The value of the option was 90 cents. So we can see it's up, right? The value of the option went up. That's exactly what the buyer wants. Now, the buyer might have thought that, it was going to come back down and maybe they want to assign it early, but they are going to be setting extrinsic value on fire. Every single time you are the buyer of an option and you exercise early, you lose all of this money. So if there's no dividends in play, you're setting money on fire. But if the dividend is going to offset your loss in extrinsic value, that might be a good idea. So here's how you calculate both if you're the buyer of the option and you want to know, is it worth it for me to get that dividend? The value of the option was 90 cents. Now, the first thing is intrinsic value. This is very easy to calculate. And what it is the share price minus the strike price. So at share price was $50.39 minus the strike price of $49.50. That means that this thing had an extrinsic value of 89 cents. Everything else left over is extrinsic value. So if it had a value of 90 cents and 89 cents of that is intrinsic value, that means that the extrinsic value was 10 cents. Oh, hey, it's Brad from the future. As you just saw, I screwed that math up pretty bad. Yeah. 90 minus 89 is 1, not 10, Brad. So instead of $10, it's really $1 of extrinsic value. I was going to go back and record the whole video again, but I didn't. It's not going to change the lesson, guys. Just every time I talk about that 10, make it 1. My bad. All right. Have a good one. This is on 100 shares. So really, if they were to exercise early and there is no dividend, they exercise early, they would be losing $10. Okay? Now, to know if this is a good deal or not, you need to know the dividend paid. So the dividend on Intel as of yesterday was for $34.75 per share. So let's just make it 35 cents. So as we see, they were going to give up 10 cents, but they were going to get 35 cents. So by exercising this option early, they actually took 35 minus 10 equals 25 cents times the 100 shares. They made out on me $25 for this contract. This is why I was assigned early. I was assigned early so the buyer of this contract, right, they could get themselves $25. But to be honest, this 25 cents wasn't even a good deal for them, right? They paid me 34 cents. They could have came around and sold this option for 90 cents. So by exercising early, they got themselves 25, right? If they would have sold to close, they would have gotten 56. Guys, this is why our goal should always be, if you're the buyer of an option, sell to close. Sell to close. The value of this option went up 56 cents per share over the lifetime of this option. Now, maybe they thought that this was a really, really big jump in Intel and tomorrow's going to crash and the value of this option was going to come crashing down, so they'd rather guarantee them 25 cents. Maybe they really wanted to own the shares and they were really bullish on Intel and they wanted them inside their portfolio. Who knows? But if they would have sold to close, they would have put $56 in their pocket. By exercising the option, yes, they got 100 shares, which is great. Okay, they got 100 shares, awesome, and they got $25, but still not a great deal for me. I hope this at least helped understand like when we're going to be assigned early. I know you guys are sick of me talking about intrinsic and extrinsic value, but right here, guys, this is the reason why, because I know there's people out there that are buying options and they're new to buying options. Please do not exercise your option early, even if there's a dividend, because most of the time you are going to have to do this. And guys, this is quick math. I just did this in 5 minutes. So you can do this all on your own. All of this information is public, guys. Just know your outcomes and know why people are doing it. Don't say, hey, why did I get assigned early? I wonder why, right? Know why, right? Know why you were assigned early, and that's going to help you be more profitable. Also know, as I knew, going into this week with an ex-dividend date, there was a really, really good chance I was going to be assigned early. That's something that you should know before you go into it. Generally, I just avoid ex-dividend dates, but I was kind of hoping for an educational video. I got one, still above my basis, still made a fair amount of money on this trade, and also too with the capital gains above my basis, I'm good. So now that you know this video, check out the long form video of why you should never exercise an option early if you haven't done so already. And until I see you on the next one, guys, stay positive, work really, really hard, always please be kind to other people. Hope you have yourself an amazing day, even better tomorrow.